Welcome to Iron Financial. We're the channel dedicated to helping you forge a stronger portfolio. How do we do that? By stress testing the market narratives and cutting right through the weakness. Today, we are putting the buckle, ticker symbol BKE, under a very powerful microscope. You know, the retail landscape right now is just littered with the skeletons of bankrupt companies. It's a graveyard out there. And yet, somehow, the buckle seems to be defying this retail apocalypse. I mean, the numbers they just posted are frankly staggering. But our job here, as always, is to figure out if this is a genuine financial fortress, something built to last, or if it's just a retail fossil that hasn't quite realized it's extinct yet. Let's get right into it.
You know, this quote from Fenterra Research really just gets right to the heart of the matter. A defiant anomaly. I mean, think about it. In today's retail climate, a store like Buckle, which is primarily based in malls, should be on life support, plain and simple. But it's not just scraping by, it's not just surviving, it seems to be thriving. But you know, anomaly is the key word there for me. Anomalies, by their very nature, don't last forever. Our whole job here is to figure out if this is some kind of sustainable, brilliant business model, or if it's just a statistical blip, a fluke, before a painful return to the mean. Let's see what the numbers have to say.
And here it is. This is the bombshell that put this company squarely on our radar. An 8% comparable store sales growth for February 2026. Let me be absolutely clear about this. In this economic environment, for a physical brick-and-mortar retailer, that number is almost unheard of. It's borderline mythical. This isn't just a simple beat of expectations. This is a statement. This suggests that the momentum they had in their stellar fourth quarter isn't just continuing, it feels like it's accelerating. I'm telling you, this is the kind of performance that forces you to stop everything, look closer, and ask the big question, what in the world are they doing right that almost everyone else is getting so catastrophically wrong?
Okay, an 8% comp is impressive, I'll give you that. But come on, one good month doesn't make a solid investment. We need to put this entire company through a full stress test. So here's how we're going to break it down. First, we're going to examine the foundation, this so-called debt-free fortress you're getting so excited about. Then we'll test their business model, what you call the perfect fit moat, but personally, I am most interested in Section 3, finding the cracks in the armor. We are going to expose all the risks before we even start talking about investor payouts. And then finally, we'll deliver the official Iron Financial verdict. Let's see if this thing is really built to last.
Okay, let's dive into this. Before we even touch those flashy sales numbers or the business model, we have to inspect the foundation. Any seasoned investor, anyone who's been around the block, knows that a company's true strength, its ability to withstand economic shocks and market turmoil, is forged in the balance sheet. So let's pop the hood, let's get our hands dirty, and put this company's financial structure to the test. Everything, and I mean everything, starts right here.
The numbers on this balance sheet, well, they tell the whole story. Just focus on that top line for a second. Nearly $319 million in cash and investments. That is the war chest. That's the fuel for everything they do. Now compare that to their inventory, sitting at a very lean $121 million. There's no bloat here, no excess fat. And what's the result of that discipline? A rock-solid stockholders' equity of almost $424 million. This is not a company that's teetering on the edge of a cliff. This is the financial bedrock of a true fortress.
And this slide, this brilliantly illustrates the absolute core of their strength. Zero. A big, beautiful zero. That's the amount of long-term debt on the Buckle's books. In a world where so many retailers are literally drowning in leverage, taking on massive amounts of debt just to keep the lights on, Buckle owes nothing to anyone. This gives them an almost unparalleled level of structural integrity and, more importantly, strategic freedom. They are not beholden to creditors. They don't have these huge interest payments just bleeding their cash flow dry every quarter. Every single dollar of profit can either be reinvested straight back into the business or returned directly to shareholders. This right here is what a true financial fortress looks like.
Okay, I'll give you that. Zero debt is impressive. It's a fantastic defense. But a fortress that doesn't generate any cash flow, that's just an expensive museum. So how do they actually make money? A clean balance sheet doesn't mean a single thing if the business model itself is flawed or outdated. So it's time to analyze their offense. Let's really see if this perfect fit moat is as deep and wide as you claim, or if it's really just a shallow ditch waiting for the first sign of trouble.
This pie chart right here shows you the engine room. This is where the magic happens. 45% of their revenue comes from their own private label brands. That is the key. When you own the brand, you own the entire margin, from the factory floor all the way to the checkout counter. There's no middleman taking a cut. Then you add to that another 40% from premium denim, which is a high-margin category by its very definition. This isn't some happy accident. This is a carefully constructed profit manufacturing machine.
And look, this strategy wasn't just dreamed up last quarter in some brainstorming session. This timeline shows a discipline that was forged over 75 years. They started as a simple men's store, made a brilliant pivot to denim way back in '67, and made the shopping mall their fortress in '77. This is a slow, methodical, deliberate build. They don't chase fads, they don't jump on every new trend. This isn't luck, it is the direct result of decades of disciplined execution. So what is their secret weapon? It's what Fentera Research calls the buckle difference. They've somehow turned the physical store, which for everyone else is a liability, into a competitive moat. First, personal styling appointments. This isn't just selling clothes, it's a service that dramatically increases the average ticket size. Second, free hemming on all denim. In an online world of close enough, they offer a perfect custom fit. This is a major differentiator that builds incredible customer loyalty. And third, and this is huge, localized merchandising. They empower their store managers to stock what actually sells in their specific market, which drastically reduces the need for those margin-killing markdowns. Their real product isn't clothes, it's a superior, high-value customer experience.
Okay, that's a powerful narrative. I get it. A debt-free fortress with a high-margin business model. It sounds great. But at Iron Financial, we don't just accept the bull case. We attack it. We kick the tires. We try to break it. No fortress is invincible, and no business model is without its flaws. So it's time to stop admiring the architecture and start looking for the structural weaknesses. Let's find the cracks in the armor, because trust me, they are always there if you just look hard enough.
Right. Everyone loves that shiny 8% growth number, but context is everything. Let's look at the numbers they probably don't want you to focus on. This chart shows a very clear downward trend in net sales for years leading up to this so-called recovery. I mean, they dropped over $100 million in sales between 2022 and 2024 alone. So this recent pop, it isn't a sign of consistent healthy growth, it's a rebound from a multi-year slump. The really important question we need to ask is, why were they slumping in the first place?
And of course, where sales go, profits are sure to follow. Net income saw the exact same erosion. From a high of over $254 million back in 2022, it plummeted down to $195 million in fiscal 2024. That's a nearly $60 million decline in annual profit. So, while the recent fourth quarter beat is fantastic news on the surface, we have to ask the hard question. Is this just a temporary bounce, what traders call a dead cat bounce, driven by a short-term denim trend? Or is it a genuine, sustainable reversal of what looks like a very worrying long-term pattern? The data here, it demands skepticism.
So let's get specific. The numbers clearly show a pattern of recent weakness before this latest turnaround. And this brings us to the fundamental question of risk. Let's just forget the past 2 quarters for a second. What are the underlying structural vulnerabilities that could cause this company to stumble again? Where, exactly, are the cracks in this shiny armor?
Here they are, plain as day. First and foremost, mall dependency. This is the big one, the elephant in the room. They live and die in shopping malls, and specifically the less premium Tier B and Tier C locations. As those big department store anchors continue to close their doors for good, foot traffic could just evaporate, leaving these little buckle stores completely isolated. Second, inventory concentration. Over 40% of their business is denim. If consumer tastes shift hard towards something like athleisure again, like they have in the past, buckle gets hit disproportionately hard. Third, the supply chain. They're exposed to the exact same shipping costs and geopolitical risks in Asia as everybody else. And finally, the silhouette shift. Yeah, they're benefiting from the shift to wide-leg jeans right now, but fashion is incredibly fickle. The constant pressure to predict the next big trend is a massive recurring risk.
Okay, those are all valid risks, but you're looking at them in a vacuum. A great management team anticipates and skillfully navigates those headwinds, and that is exactly what this team is doing. You see, their counter-argument isn't some fluffy press release. It's cold, hard cash being returned directly to shareholders. Let's take a look at how they're actively proving the market wrong.
This slide right here directly refutes your whole dead cat bounce theory. Yes, fiscal 2024 was weak. You can see it right there in the column on the left. But now, look at the response in fiscal 2025 on the right. They didn't just stop the bleeding, they engineered a powerful, decisive turnaround. Net sales are up 6.6%. Comp sales flipped from a negative 2.7% to a positive 5.6%, and earnings per share are climbing again. That's not a bounce, that is a clear demonstration of operational control.
And a huge part of that stability comes down to the continuity of their leadership. This is the CEO, Dennis Nielsen. His story is absolutely incredible.
He started as a part-time salesperson for the company way back in 1970 and has been the CEO since 1997. This isn't some hired gun CEO who's just looking for a quick payday and a golden parachute. This is a leader with over 50 years of experience inside this specific company. He's navigated multiple economic recessions, countless fashion cycles, and the entire rise of e-commerce. This steady, experienced hand at the tiller is an intangible asset that you just can't quantify on a balance sheet, but it's absolutely critical to their success.
Now let's address that mall dependency argument head on. While everybody else is screaming about the retail apocalypse and closing hundreds of locations, what did Buckle do? They ended the year with 440 stores, a net decrease of only one store. One. They are not in retreat, they are optimizing their fleet, they're closing a few underperformers, sure, but they're also opening new, larger format stores and completing 18 to 22 full remodels every single year. This is a sign of stability and confidence in their physical footprint, not weakness. They are holding the line.
And this right here, this is the ultimate proof point. This is management putting their money where their mouth is. In January of 2026, they paid out a total dividend of $3.35 per share. That includes a massive $3 special dividend. This is a tangible reward for shareholders. It's a signal of immense confidence from the board that their cash flow is so strong and their balance sheet is so clean that they can return nearly $200 million to investors in a single year and not even break a sweat. This isn't just a dividend, it's a power move.
All right, we've seen the fortress balance sheet and that very impressive payout. But we have also exposed the cracks in the armor. The mall dependency and the fashion risk are real. It's time to weigh the evidence. We've laid out both sides of the coin. Now it's time for us to deliver the verdict. Is the Buckle an opportunity to forge a stronger portfolio, or is it a classic value trap just waiting to spring?
To be crystal clear, the bull case rests on undeniable financial strength. You've got zero debt, massive cash flow, huge special dividends, and proven operational excellence. Plus, this turnaround clearly has momentum, and the bear case argues that this fortress is built on a crumbling foundation. They're tied to dying malls, they're basically a hostage to fashion trends, and they're facing some serious questions about their valuation. Can they really defy the laws of retail gravity forever? I have my doubts.
Let's just look at the valuation for a second. BKE is trading at a PE ratio of 12.4. The rest of the retail sector is hovering around 18. That is a clear mall risk discount being applied by the market. In other words, the market is pricing in failure, which if you're a bull, gives you a significant margin of safety. I disagree completely. I'd argue that discount is not only fair, it's completely justified. That 12.4 PE isn't some bargain. It's a rational price for a company that has massive structural risks. The market isn't blind. It sees the same cracks in the armor that we do, and it's pricing them in accordingly.
So when you boil it all down, it comes to this single question. Is Buckle's high-touch, high-service model an unbreakable moat that can actually defend against the slow, undeniable decline of the American mall? Or is this simply the last, valiant stand of a very well-run company in a dying industry? The answer to that question will ultimately determine whether this is a fortress or a fossil. Thank you for joining us at Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.